let's talk about what the global markets are showing before we talk about domestic names. So it's Monday when we get your Global Voice to talk about all the global factors making the headlines and the impact. Joining us today is Daniel Morris. He's Senior Investment Strategist at BNP Paribas Asset Management from UK. Daniel, good having you, and thank you so much for taking the time out. Good morning to you out there. How are you viewing the current developments and the impact that it could have on equity markets per se? One, the US, China calling off their so-called trade war, but that having little or no impact on asset classes by and large. Crude has continued its merry ways. Equity markets are not duly reacting. And two, there's part two of that question. What's happening to crude and the resultant impact on inflation parameters for almost all economies, particularly emerging markets?
Absolutely. I think it is very notable that even with this apparent progress between the U.S. and China on the trade front, you haven't seen that much impact on equities. And I think it explains why up to now a lot of people have explained the somewhat lackluster performance of equities on trade tensions. We never really put much credence into that. We weren't too worried about an escalation towards a trade war. So then if that problem seems to become resolved, you haven't then seen the big rebound. So it suggests it wasn't such an issue in the first place. We think it's been much more about the increase in U.S. interest rates. That's what's dragged on the market despite what was a very, very good earnings season in the U.S. You didn't see much reaction in stocks. Clearly the rise in rates and therefore the rise in the dollar has dragged on emerging market equities, and that factor is probably going to persist longer than necessarily the concerns we currently have around trade tensions.
Right, Daniel. So keeping in mind your expectations when it comes to the U.S. interest rate trajectory, how are you expecting American equity markets to move, say, over the next couple of months?
Well, I think in the short term, it's probably going to continue to be a bit choppy. I don't know that we're finished in terms of rising rates in the U.S. We know we have more issuance coming from the U.S. Treasury now this week to fund a rising U.S. budget deficit. As you pointed out, the increase in oil prices is having an impact on inflation expectations, even if you really shouldn't expect a short-term move in the oil prices to drive inflation expectations today. That's the way it works. And so with higher inflation expectations, then that means higher U.S. Treasury yields and yields elsewhere. So I think in the short term, it's going to continue to be challenging for equities. The reason we're not terribly concerned, however, is if you look at the underlying earnings growth trend, it's still quite positive. So it's suggesting in the medium term, you still should have profit growth, and that's the most important thing for equities. But in the shorter term, higher rates is probably going to be a bit of a drag.
Right. In that case, what does it mean for fund managers out there when it comes to allocations of funds across America and Europe in comparison to some of the relatively more emerging economies?
Well, I think one thing that's changed this year, say, versus last year is there's less obvious valuation gaps between the markets. Decisions you made last year could have been based on, this market looks overvalued and this one at least relatively less expensive, and so I'm going to allocate accordingly. With rising earnings expectations but modest prices, you've actually seen price earnings multiples decline. And now there's not such a big gap between, say, developed markets and emerging markets the way you had last year. There's not such a big gap between the U.S. and Europe like you had last year. So the valuation perspective is more balanced. So I think what investors need to do, asset managers need to do, is to evaluate their earnings trend as opposed to the possibility of a compression or an expansion in multiples. So from that point of view, I think you're probably still interested in U.S. technology, where we see quite strong positive earnings revisions, where you're more concerned certainly about interest rate sensitive sectors in the U.S., and frankly, for the short term, probably still concerned about emerging markets with the dollar strengthening.
In fact, what impact does dollar, that even in dollar strengthening, or the one that we've seen thus far as well, have on emerging market exporting nations, if any? Because we haven't seen a material correlation, but for there being a sentimental correlation in the short term, and it's very difficult to figure out whether the dollar will have exemplary strength vis-a-vis the EMs over the course of the remainder of the year as well. What's the base case assumption, Daniel?
Well, our base case is that the dollar ultimately will revert to a depreciating trend against both emerging market and developed market currencies. So by the end of 2018, but in the short term, we think it probably will continue to strengthen because these interest rate expectations certainly continue to move up in the U.S. Now, for emerging markets, that a stronger dollar in the short term, you think, should be better for certainly EM exporters. I think the reason you haven't seen a more positive reaction among them is we think fundamentally the market doesn't think the dollar is going to appreciate over the medium term, so you don't really get the medium term benefit for the exporters. And of course, in the short term, it just reduces your local currency return, and so that's not particularly attractive. The other concerns clearly that we have is what's happening to sentiment towards emerging markets, and starting with Argentina, now with Venezuela, are investors that aren't necessarily emerging market specialists starting to see more bad news coming out of emerging markets and the risk that they start repatriating their funds, certainly out of emerging market debt and then emerging market equities, because at this point, a 3.1% yield on U.S. Treasuries looks quite good on a risk-adjusted basis. So I think we're waiting to see how far that sentiment swings against emerging markets before really feeling it's a good time to go back in.
Part two of my question then, Daniel, and final question from mine at least, would be that if the LATAM emerging markets are facing such major issues, and we, as you rightly said, both of the nations are under a big question mark, would favorably placed EMs, the likes of India and others, find favor? And if you track India from a top-down approach, do you believe that there is a case for money to move into India? Because thus far, we've only seen outflows, majorly seen outflows in the current calendar from out of India.
Yeah, well, we think that's probably driven by this broader swing to negative sentiment towards EM. Clearly, this year, Latin America, on one hand, has benefited from the surprising rally in oil prices and commodity prices generally. It's a question of how much further that can go. Certainly for oil, it does seem to be driven a lot by short-term factors now, Iran the most obvious one, but supply constraints, Venezuela, and so on. And whether that necessarily will persist. So if you ultimately see a lower oil price between now and the end of the year, that's going to take some of the momentum away from LATAM and the commodity exporters. The reason we are more optimistic on Asia, EM in particular, and also larger domestic demand-driven markets like India, Indonesia, domestic China, and so on, is that we think that's the opportunity. We like the service story, we like the consumer demand story within emerging markets, and think that's the better medium-term play than the commodity-sensitive markets, and in addition, really the exporters that with what we think is going to be a higher level of trade tensions to some degree permanently could be a drag on those markets.
Daniel, the usual concerns with foreign investors in India is its valuations. At what point in time do valuations become relatively more attractive for India when compared to other Asian economies right now? Because the reason I ask is we have seen the Indian equities come off from their lifetime highs.
Well, emerging markets valuations on a lot of them, if you say look 1 year out in terms of earnings expectations, do seem quite high, but really you should be pricing or trying to price 3 to 5 years out. And from that point of view, given the earnings growth potential that you have in India, it would suggest the valuations may seem a little bit overstated. You have still significant reform prospects within India, and if that's implemented, if it's actualized, you should see significant profit growth, and that's going to support the valuation. So in the short term, certainly maybe some investors are shying away because multiples do seem higher than some of the markets, but we hope that that really is driven fundamentally by brighter earnings prospects.
Okay, Daniel, we'll leave it at that. Thank you so much for taking the time out and speaking with us today at Bloomberg Quint India, and have a great week ahead.